Picture this. You want to be a real estate investor. You like collecting rent, owning a piece of the skyline, watching property quietly pay you while you sleep. But you do not want the other half of that deal. The down payment that wipes out your savings. The 30-year mortgage, the tenant who stops paying, the roof that springs a leak at 2 in the morning. Here's the wonderful thing. There's a way to own a slice of apartment towers, warehouses, data centers, even the cell towers your phone connects to. For the price of a single share of stock. No mortgage, no tenants, no leaky roof. And the law actually forces this thing to take most of its profit and hand it straight to you. It's called a REIT, a real estate investment trust. By the end, you'll know how a REIT works, the two main flavors, why the dividends hit your taxes differently, and where to hold them. Let's break down how you become a landlord without ever owning a building. Let's start with the simplest question. What actually is a REIT? A REIT is a company. But instead of making phones or selling coffee, its entire business is income-producing real estate. It owns it, operates it, or finances it. Think apartment buildings full of renters, warehouses, data centers, towers carrying cell signals. And it works as a pass-through. Thousands of investors buy shares. All that money pools inside the REIT. It buys and runs real estate, and the rent and interest flow in, then flow right back out to shareholders as dividends. You're a tiny landlord without any of the work. Now, compare the two ways to get real estate income. Buy a whole rental property, and you need a large down payment, a mortgage, tenants to screen, late rent to chase, things to fix, and your money is locked in bricks you cannot sell quickly. Buy one REIT share instead, and you're trading on a major exchange, the New York Stock Exchange or the Nasdaq, just like a regular stock, through any ordinary brokerage. One share can cost just tens of dollars versus the tens of thousands a down payment demands. It's liquid, diversified across many buildings, and completely hands-off. Now, the defining rule, that's the single mechanic that makes a REIT, and the reason they're famous as dividend machines. To qualify as a REIT, and to avoid paying corporate income tax on its profits, the company must distribute at least 90% of its taxable income to shareholders as dividends, every single year. Not can if it wants to. Must. It's a trade with the tax code. Hand almost everything to your shareholders, and we won't tax that income at the company level. And in practice, REITs go further. The minimum is 90%. But most distribute close to 100%, because anything they keep gets taxed at the corporate level. That's exactly why REITs are known for high, steady dividends. The payout isn't management being generous, it's baked into the law. That 90% rule gets the headlines, but a company has to clear a few more tests. It must invest at least 75% of its total assets in real estate, cash, or government securities, and earn at least 75% of its gross income from real estate sources, like rent and mortgage interest. And it has to be widely held, at least 100 different shareholders, with no 5 people owning more than 50%. That last one has a nickname, the 550 rule. Together, these tests make sure a REIT really is a broadly owned, genuine real estate business. So far, I've said a REIT as if they're all the same. They're not. There are 2 main types, and they make money in completely different ways. Type 1 is the equity REIT, what most people picture. It owns the building. It's the landlord. It buys property, operates it, and earns rent. Apartments, malls, warehouses, offices. Equity REITs make up the large majority of the U.S. REIT market. When people say REIT, this is almost always what they mean. Owns the building, collects the rent. Type 2 is the mortgage REIT, often shortened to mREIT. It doesn't own buildings. It owns the loans. It finances real estate by holding mortgages and mortgage-backed securities, and instead of rent, it earns interest. It's less the landlord, more the bank behind the landlord. Mortgage REITs are a much smaller slice, only around 6% of the market per Nareit, owns the loan, collects the interest. Here's the trade-off. mREITs typically carry higher yields, but with greater interest rate sensitivity and a lot more price volatility. A date-stamped snapshot from Nareit February 2026 Equity REITs were yielding about 3.7%, mortgage REITs about 12.1%. And I have to be crystal clear. That's an example only. Yields change constantly. That gap is not a free lunch. The higher mortgage REIT yield is the market pricing in real higher risk. Now, the part almost nobody warns you about until tax time. REIT dividends are taxed differently from the dividends on a typical stock. When a regular company pays you a dividend, it's usually a qualified dividend, taxed at the lower long-term capital gains rate. But most REIT dividends are not qualified. They're ordinary dividends, taxed at your regular marginal income tax rate, the same rate as your paycheck. At the very top, that's the 37% top federal bracket, versus the much lower qualified dividend rate a normal stock gets. But there's a real softener, the Section 199A deduction, the qualified REIT dividend deduction. It lets eligible individuals deduct 20% of their REIT dividends before tax. Knock 20% off the taxable amount, and the top effective federal rate on REIT dividends drops from that 37% down to about 29.6%. Still higher than a qualified dividend, but meaningfully better than the raw ordinary rate. And this isn't a temporary perk. Section 199A was made permanent by the One Big Beautiful Bill Act in 2025. At tax time, you'll find these qualified REIT dividends in Box 5 of your Form 1099-DIV. So, full ordinary rate minus the 20% deduction equals a lower effective rate, higher than a normal stock dividend, but not as brutal as the headline sounds. So if REIT dividends mostly get taxed at your higher ordinary rate, there's an obvious question. Where should you actually hold them? Here's the key idea. Because REIT income is taxed as ordinary income, REITs are a classic candidate for a tax-advantaged account, a traditional IRA, a Roth IRA, or a 401k. Inside those accounts, your investment income isn't taxed as it's earned. So that steady stream of dividends, which would otherwise be dragged down by your marginal rate year after year, gets to compound sheltered from that drag. But here's the trade-off people miss. That 20% Section 199A deduction only applies in a taxable account. Hold your REIT inside an IRA or 401k, and you give up the deduction. But that's fine, because the income there isn't being taxed at all. So the decision map is clean. A taxable brokerage gets the 20% deduction, but eats the ordinary rate drag every year. A tax-advantaged account shelters the income, so you don't need the deduction. One more flag before you go shopping. Publicly traded REITs, the ones on the exchanges, are liquid. You can buy and sell them any trading day. But non-traded REITs aren't listed on an exchange, so they're illiquid, hard to sell, possibly locked in for years. For most everyday investors, the liquid publicly traded kind is the straightforward choice. And to say it plainly, this is educational, not financial or tax advice. Where you hold a REIT depends on your situation, so talk to a qualified professional first. Let's pull it together. A REIT lets you own income-producing real estate about as easily as buying a stock. No mortgage, no tenants, no 2 a.m. plumbing emergencies. By law, a REIT must pay out at least 90% of its taxable income as dividends, and most pay close to 100%, which is why REITs are dividend machines. Remember the two types. Equity REITs own the buildings and collect rent, and are the large majority of the market. Mortgage REITs own the loans and collect interest, with higher yields but more volatility. And don't forget the tax catch. Most REIT dividends are taxed as ordinary income, not the friendlier qualified dividend rate. Though the 20% Section 199A deduction softens the blow. That's the very reason so many investors hold their REITs inside an IRA or a 401k. The law forces the payout, the type tells you the engine, and the account you choose decides how much you keep. And remember, this is education, not advice. Your own situation is the deciding vote. If REITs just clicked for you, if Landlord without the property suddenly makes sense, hit subscribe. That's the whole point of this channel. The money concepts nobody ever sat you down and explained. And here's your perfect next step. A REIT lets you own a basket of real estate in a single ticker. And that same own a whole basket in one buy idea powers the most popular investments on earth. index funds, and exchange-traded funds. They sound almost identical, yet there are real differences in how they trade and how they're taxed. So which should you actually own? Watch the next video, Index Funds versus ETFs, and I'll show you exactly how they differ.